welcome to the deep dive. You know, when you look at the market swinging wildly, it really is easy to feel overwhelmed. Like maybe trading's just luck.
Yeah, it seems that way sometimes, but the sources we've dug into, they paint a really different picture. It's not about gambling, it's much more about, well, strategy, psychology, and frankly, unshakable discipline.
Exactly. So our mission today is to kind of cut through all that noise.
Yeah.
We want to give you, the listener, a blueprint that actually lasts. We're pulling together wisdom from, gosh, decades of market history.
Right, into steps you can actually use, like right now. Doesn't matter if the market's up 20% or down 15%. These ideas are evergreen.
Okay, let's unpack this then. We're going to skip the absolute basics you probably already know and jump straight into what our sources call the timeless top tricks. The goal here is turning knowledge into, well, action. Because really, in trading, the real edge, it's your discipline.
Mm-hmm. And it all starts at the foundation, building your, let's call it, your trading fortress.
Yeah, and that fortress isn't just about opening an account, is it?
No, not at all. It's the commitment, really, to continuous learning. Our sources are really clear on this. You have to see trading as a skill, something that needs constant study.
Like dedicating time.
Yeah, carve out, say, 30 minutes every day. Treat it like a class you can't skip.
And where do you even start with that learning? The material points back to the classics, right?
It does. You really need to understand the why before the how. So yeah, Benjamin Graham's The Intelligent Investor, it's still the bedrock. And then use online stuff like Investopedia, but for the deeper concepts, not just quick definitions.
Oh, gotcha. So philosophy first, then tactics.
And that educational process, it feeds directly into this idea of the circle of competence. It sounds simple, but it's huge.
Meaning stick to what you know.
Pretty much. Don't trade, I don't know, biotech if you don't understand biotech. If you work in tech, maybe research tech companies. It keeps your research focused, keeps your conviction up when things get rocky. And honestly, it boosts long-term profit potential because you're less likely to panic sell.
That makes sense. Grounding the knowledge. Okay, practically speaking, though, you do need to get set up.
Right. And the advice is start small. Maybe $500, $1,000 in a brokerage account. You don't need a fortune to begin learning.
But there's this pro tip that sounds kind of basic, but the sources really hammer it home. Paper trading. The demo account.
Oh, absolutely non-negotiable. It's like flight school before you fly solo. You can read every book out there on market psychology.
Right.
But until you actually see a simulated, say, $500 loss flash on your screen, you haven't truly tested your discipline. Paper trading lets you test everything, your strategy execution, your rules, your emotions, without paying real money for the lessons.
So it's like tuition-free market experience.
Exactly.
Okay, let's talk tools then. We need to see more than just a price, yeah? Understanding the market's language. Candlesticks come up a lot.
Essential. They really tell the story of price action visually. You know, the open, high, low, close for a period. It turns kind of chaotic data into something you can actually digest. Green up, red down, the body, the wicks. It all means something.
And then you have tools to smooth out that noise, right? Like moving averages.
Precisely. MAs help you see the trend direction by averaging out past prices. The key ones are usually the 50-day moving average that helps with the short to medium-term trend.
Okay.
And the 200-day. That one's really the big one for the long-term health of whatever you're looking at.
But averages can lag, can't they?
Right.
Especially if the market's moving fast. This is where volume comes in, I think.
Yes, volume is crucial. Think of it as confirmation. High volume on a move, whether it's up or down, suggests the big players, the institutions are behind it. There's real conviction.
And low volume.
Low volume moves are often just noise or temporary fake outs. You really need that combination. The picture from the candlesticks, the trend from the moving averages, and the conviction from the volume.
Got it. Picture, trend, conviction. That whole toolkit then helps you filter which strategies to use.
Exactly. Which brings us nicely into the core strategies, the ones that separate, the disciplined wealth builders from the speculators.
Okay, let's start with maybe the simplest but arguably most powerful. Buy and hold. The Warren Buffett way. Right. Quality stocks, long-term compounding.
Yeah, the core idea here is patience.
Yeah.
And good screening. You have to look for companies with strong competitive advantages, what Buffett calls moats. Things like brand power, network effects, maybe unique tech. Plus, you want consistent earnings growth.
So you're looking for stability.
Right. And the sources often suggest putting a big chunk of your portfolio, maybe even 70%, into this kind of strategy for that bedrock stability.
Okay, but here's a question then. If buy and hold is so effective, historically giving like 7-10% annual returns,
yeah,
why bother with all the daily learning, the other strategies? Why not just I don't know, buy an S&P 500 index fund like VOO and check back in 20 years?
That's a really good question. And the answer is successful buy and hold still requires that ongoing education. You need the knowledge to pick quality stocks in the first place, to understand if a company's moat is maybe starting to crumble, or even just to recognize when a great company becomes ridiculously overpriced. Buffett didn't just buy and forget. He's constantly analyzing. If you don't know why you own something,
you'll sell it at the worst time.
Exactly, when fear kicks in.
Understood. So education fuels the conviction to hold. Okay, next strategy. Dollar cost averaging, DCA, the anti-timing hero.
Right. This one's all about discipline through math. You invest a fixed amount of money at regular intervals, say weekly or monthly, no matter what the price is doing.
Kicks the emotion out of trying to buy the dip perfectly.
Completely. You just set up an automatic investment, maybe $100 a week, into a broad index ETF like VOO or SPY. It's probably the easiest win for beginners. And crucially, the sources really stress this. Don't stop when the market crashes.
You actually buy more shares then, right?
Yeah.
Lower prices.
Exactly. That's when DCA really shines. You're buying bargains automatically. Historically, it tends to outperform trying to time lump sum investment, especially in down markets.
Okay, DCA is foundational. But let's get into the more active stuff. Swing trading. This is where the timeline shifts from years down to, days or weeks?
Yeah, swing trading is about capturing shorter-term market moves, those swings, typically holding for maybe 3 to 10 days. The goal is smaller, quicker gains, maybe 2-5% per trade. But if you're disciplined, those can compound really nicely over a year.
And this relies heavily on technicals, right? Like RSI.
Very much so. Technical indicators are key. The Relative Strength Index, RSI, is a big one. It measures the speed and change of price movements, basically momentum.
And the simple rule is over 70 is overbought, maybe sell. Under 30 is oversold, maybe buy.
That's the textbook definition, yeah. But just buying because RSI hits 30? Well, that can be like trying to catch a falling knife, as they say.
So there's nuance there. What's the key?
You never, ever use RSI in isolation. That's the pitfall. If RSI hits 30, but the price is still way below its 50-day moving average and volume is weak, that signal probably isn't reliable. You use RSI together with the moving averages to understand the trend context. And always look for volume confirmation. You'd only really consider buying that oversold signal if the price starts showing signs of turning back towards the prevailing trend, and importantly, if you see volume picking up on that turn.
Okay. So it's about confluence, multiple signals lining up. That makes it actionable, not just a mechanical rule.
Precisely.
All right, quickly touching on the other two main frameworks. First, value investing, finding bargains, like Peter Lynch.
Yep. Value investors are hunters. They're looking for stocks that are trading significantly below what they calculate as their intrinsic value, maybe 20-30% cheaper.
And how do they figure out that intrinsic value? You mentioned discounted cash flow, DCF.
Right. DCF is a common model.
Okay, stop me there. For someone who's heard of DCF but never actually done one, what's the quick explanation? How do you get that value?
It's actually more intuitive than it sounds. Think of it like this. What's a business worth today based on all the cash it's expected to generate in the future? That's what DCF tries to figure out.
So you're forecasting future profits.
Future cash flows, yeah. Usually for maybe the next 5 or 10 years. Then, and this is the key, you discount those future dollars back to what they're worth today. Because, a dollar today is worth more than a dollar next year.
Right, time value of money.
Exactly. So you add up the present value of all those future cash flows, and that gives you an estimate of the company's intrinsic value now, if the stock is trading for less than that calculated value.
It's potentially a bargain, a value play.
Correct. And like Peter Lynch said, know what you own and know why you own it. The why often comes from that value calculation.
Got it. And then kind of the opposite end of the spectrum, momentum trading, riding the hot streaks.
Yeah, betting on the winners to keep winning. Stocks that are already moving up strongly, maybe up 20% or more in a month with high volume.
Sounds exciting, but maybe risky.
Extremely. Momentum is a fast, agile strategy. It looks simple, buy what's going up fastest, sell what's falling, but it's volatile. Momentum can vanish in an instant.
So you need a safety net.
Absolutely. You have to blend it with some fundamentals. Ray Dalio's warning fits perfectly here. He who lives by the crystal ball will eat shattered glass. If you're only chasing price without knowing if the company is actually solid, you're setting yourself up for a nasty crash when the momentum fades.
Okay, so we have these different frameworks. Buy, hold, DCA, swing, value, momentum. How do you put them together? The sources suggest a kind of portfolio mix.
Yeah, for someone who's got the basics down and wants both long-term growth and some active income potential, a suggested blend might be something like 60% and buy and hold for that core stability.
The anchor.
Right. Then maybe 20% allocated to swing trading for more active growth. Then perhaps 10% held in cash, for operational flexibility, dry powder. And the final 10%, maybe for more leveraged strategies like options.
Options. Okay, that introduces a whole other level of risk, doesn't it?
It absolutely does, which is why it's crucial. It's limited to a small slice, maybe that 10%. And it's the perfect transition to what might be the most important part, the invisible shield of risk management and psychology.
Right, because the sources say strategy is only maybe 20% of the equation.
At most. Your mindset, your emotional control, and how you manage risk, that's the other 80%. Honestly, unmanaged risk is the only thing that truly guarantees you'll fail in the long run.
Okay, let's nail down the rules then. 4 non-negotiables for protecting your capital. First, and maybe the most critical, the 1% rule.
Yes. Never, ever risk more than 1% of your total trading capital on any single trade idea. So if you have a $10,000 account, the absolute maximum you should be willing to lose on one trade is $100, period.
Why is that so important?
It saves you from the death spiral. Losing streaks happen to everyone. But if you stick to the 1% rule, even 5 losses in a row only puts you down 5% overall. Your capital is still largely intact. You can keep trading, stay in the game, and recover. It forces capital preservation, which, like Buffett says...
Rule no 1, never lose money. Rule no 2, never forget rule no 1.
That's it. The 1% rule makes rule no 1 practical.
But hang on, if I'm only risking 1%, let's say I'm aiming for a 2% gain. How does that build wealth efficiently? It feels kind of slow.
But that's where the other side of the coin comes in. The risk-reward ratio. You should only be taking trades where your potential reward is at least twice your potential risk. A 1-to-2 ratio minimum.
So risk $100 to make at least $200.
Exactly. If you consistently find trades with that kind of positive asymmetry, even if you only win, say, 55% of the time, you will compound your wealth quite effectively over time. It's about consistently stacking small, high probability, positive expectancy bets, all while keeping that risk capped at 1%.
Okay, that makes sense. It's the combination. Rule 2, mandatory stop losses.
Yes. The moment you enter a trade, you must place a stop-loss order. This is an automatic exit point, usually set maybe 5% to 8% below your entry price.
Takes the emotion out.
Completely. The market hits your stop level, you're out. No hesitation, no second guessing, no hoping it'll just come back. It enforces discipline when you're most likely to be emotional.
Rule 3, diversification. Don't put all your eggs in one basket.
Right. A general guideline is no more than 5% of your capital in any single stock. And try to maintain at least 10 to 15 different positions if you're actively stock picking across different sectors if possible.
And the final rule, the drawdown limit.
This one's about psychological protection. Set a limit. Say, if your account is down 10% in a month, you just stop trading.
Just stop. Cold turkey.
For a period, yes. That 10% drawdown is a signal. It means something's wrong. Either your strategy isn't working in the current market, or maybe your personal discipline has slipped. You have to step back, take a break, review your journal, reflect, and figure out what's going wrong. The absolute worst thing you can do is revenge trade.
Trying to win it all back quickly with bigger, riskier bets.
Yeah, that just digs the hole deeper faster. The drawdown limit forces a reset.
Okay, that reflection piece leads us straight into the 80% edge. Trading psychology. Conquering, as the sources say, fear, greed, and FOMO, the fear of missing out.
It's huge. And mastering this isn't vague self-help stuff.
Yeah.
It requires specific actions, rituals almost. Number 1, journal everything.
Not just the trade details.
No, that's the easy part. Log the entry, the exit, the profit or loss. But critically, log your emotions. How did you feel before you took the trade? Anxious? Confident? Impulsive? How did you feel during? Were you tempted to break your rules? And after? Elated? Depressed? Why?
And then review it.
Religiously. Every week. Look for patterns in your emotional responses and how they correlate with your trading results. This self-awareness is incredibly powerful.
I think one of the biggest psychological hurdles, especially for active traders, is just patience. Waiting for those really good A-plus setups.
Yeah.
The material says like 80% of your time should be watching, not actually trading. How do you cultivate that patience?
It's trained discipline again. It comes back to having those predefined entry and exit rules based on your strategy, like waiting for that RSI and volume confirmation we talked about.
So the rules create the patience.
Exactly. You're not just randomly clicking buttons because because the market moved. You are waiting patiently for the market conditions to perfectly match your established, tested rule set. You let the good trades come to you, and you learn to view the inevitable small losses.
The 1% ones.
Right. Not as failures, but as, let's say, tuition for wins.
Yeah.
They're the cost of doing business, necessary learning experiences kept small by your risk rules.
That long-term learning mindset really connects to the wisdom from the market legends, doesn't it?
Absolutely. We already mentioned Buffett's rule number 1, capital preservation above all. That 1% rule is the embodiment of it.
And Peter Lynch's point about trying to time corrections.
Yeah, far more money has been lost by investors preparing for corrections than has been lost in corrections themselves. It's a warning against constantly trying to be tactical, jumping in and out. Often staying invested through the noise, assuming your own quality assets, is the better long-term play. Consistent application over frantic timing.
The sources also pull lessons from movies, which I find kind of memorable. Wall Street, Gordon Gekko.
Greed is good, a classic line. But the real lesson from Gekko, in the context of trading discipline, is about the dark side of uncontrolled ambition. That short-term greed, like ignoring your 1% rule for one sure thing or skipping your stop loss hoping for a bigger win, that's what ultimately erodes long-term wealth. Ethics and rules over excess.
And then the big short. The guys who bet against the housing market in 2008.
Right. The key takeaway there for a trader is the power of contrarian thinking and questioning the consensus. Don't just accept the popular narrative. When everyone is bullish and euphoric, maybe start looking for signs of weakness. Use contrarian scans. Look for those hidden asymmetric risks that the crowd is ignoring, like they did with subprime mortgages.
So these stories aren't just entertainment, they reinforce the discipline. Skepticism and integrity as part of risk management.
Exactly. Trust your own research and your rules over the market hype.
Okay, so assuming you've internalized all this, the foundation, the strategies, the risk rules, the psychology, you can start fine-tuning. The goal is hitting that consistent edge, right? Mm-hmm. A win rate over 55%, and that positive risk-reward ratio, like 1 to 2 or better.
That's the performance target. And you manage it within that layered portfolio structure we touched on, the 60% buy hold, 20% swing, 10% cash, 10% options, or whatever allocation fits your risk tolerance and goals. That small option slice gives you potential for outsized gains, but the risk is contained because it's only 10% of the total pie. If it goes sour, 90% of your capital is still safe and working.
Right, so let's bring it home. What does this all mean for you, the listener, right now? You've got the map, essentially, the compounding strategies, the risk tools like the 1% rule, the psychological armor, building real financial legacy. It's a marathon, not a sprint, built on this kind of discipline.
Absolutely. And the simplest, most immediate action step you can take, literally today, start that dollar cost averaging.
Yeah.
Set up a small regular investment into a broad market ETF. Just start.
And beyond that first step, maybe keep Peter Lynch's other piece of wisdom in mind. The best stock to buy may be the one you already own. It speaks to conviction, knowing your holdings, owning your process.
Mm-hmm. And one final thought for reflection, drawn from how the best investors operate. They perform regular, usually annual audits. They review everything. They adapt not just to normal market shifts, but even to massive black swan events like pandemics without panicking. So the question for you is, how will you structure your own annual review? How will you analyze your trades, audit that emotional journal, and ensure your discipline evolves and strengthens throughout your entire financial journey? That ongoing review, that commitment to evolution, that's the real path to lifelong wealth building.